Every trader wants to know how to make money, but few ever stop to ask the question that truly matters. How do I keep it? Because making money in the markets is easy. Keeping it, that's what separates the wise from the doomed. I've seen markets that look like rivers of gold turn into deserts overnight. I've seen men who called themselves geniuses lose everything they owned in a single panic. And I've seen fear make the boldest men beg for mercy when the market turned against them. You see, I didn't learn about risk management from a textbook or a seminar. I learned it by standing in the noise and chaos of Wall Street, by watching fortunes made before noon and destroyed before sunset. Every victory, every defeat, every sleepless night taught me one thing. The market is not your enemy, nor your friend. It is an impersonal force, one that rewards discipline and destroys arrogance. Before we talk about profits or strategy or systems, you must understand this. Trading is not about prediction. It's about preservation. The first goal of a trader is not to get rich, it's to stay solvent. To survive long enough for your wisdom to compound, for your patience to pay dividends, and for your judgment to sharpen with time. That's why today I want to share with you the foundation that kept me alive through market crashes, panics, and bubbles. 12 rules of risk management. Rules that have nothing to do with luck and everything to do with discipline. They were carved not on paper but on my soul, through mistakes, through loss, through the humility that every real trader must face. If you follow them, you may not become rich overnight, but you'll still be standing when the others have fallen. Because risk is not something you eliminate, it's something you learn to live with, respectfully, intelligently, patiently. If this message speaks to you, subscribe to this channel now. Here we don't chase quick riches, we build lasting traders. Step by step, lesson by lesson, we master the most important skill of all, survival. Now, let's begin. Jesse Livermore's 12 Rules of Risk Management. Rule number 1. Never lose all your ammunition. Capital is your ammunition. It's the lifeblood of your trading career. Once it's gone, your opportunity to fight is gone with it. Every trade you make is a battle, and like any soldier, you march into the field with a limited supply of bullets. If you fire carelessly, if you waste them chasing every noise, every flicker of movement, then when the real opportunity arrives, you'll have nothing left to use. Most traders fail not because they lack strategy, but because they lack ammunition when it matters most. They bet too big on the wrong idea. They fall in love with a single trade, and they forget that their capital isn't infinite. I've been there. Early in my career, I made the same mistake. I'd make a fortune on a brilliant play, and then lose it all trying to repeat the miracle the very next week. I learned that it wasn't brilliance that kept a man in the market, it was restraint. A good trader doesn't waste his soldiers. He sends them into battle only when the odds are clearly in his favor. And when the fight turns against him, he retreats. With enough left to fight again another day, you must treat your capital as sacred. Protect it with the same care a general gives his army, because the market rewards those who survive. Not the reckless, not the impulsive, not the ones who go all in. So when you look at your trading account, don't see numbers on a screen, see soldiers on a battlefield. Each one valuable, each one irreplaceable. Use them wisely, preserve them fiercely, because without ammunition, even the greatest strategy is useless. The first step to victory is making sure you live long enough to take it. Rule number 2, cut losses quickly, cut excuses faster. Every trader faces losses. They are not a sign of failure. They are the cost of doing business. What destroys traders isn't losing, it's refusing to lose soon enough. The biggest mistake a trader can make is to believe the market owes them a recovery. It doesn't. The market never apologizes, and it never corrects itself just to prove you right. When the price moves against you, that's not betrayal, it's information. It's the market speaking. And you must learn to listen without pride, without emotion. When a trade turns bad, act. Don't hesitate. Don't justify, don't pray, cut it while it's small, because a small loss is a bruise, a large loss is amputation. I remember one trade in particular. I believed I was right. Every instinct told me the market would turn, so I waited and waited. By the time I admitted defeat, the damage was done. The loss wasn't just financial, it was psychological. It taught me a lesson I never forgot. The first loss is the best loss. Every second you spend making excuses is another dollar you surrender. And the market, it collects those dollars mercilessly. If you find yourself thinking, I'll move my stop just this once, remember, I once thought that too. That's how careers end quietly, one small rationalization at a time. A trader's greatest strength isn't courage, it's discipline. And discipline means accepting you were wrong before the market makes sure everyone else knows it. So the next time a trade goes against you, don't hesitate. Don't explain it away. Don't defend your ego. Cut the loss and cut the excuses even faster. Because in the long run, it's not the loss that kills traders, it's their pride. Rule number 3, don't average down. One of the oldest temptations in trading is the urge to average down. To buy more when the market moves against you, believing that somehow by lowering your cost you can erase your mistake. But hear me clearly, that is not a strategy. That is a slow-motion surrender. I was being clever. In my early years, I tried it too. I'd take a losing position, then add to it, thinking I was being clever, or patient, or brave. But the truth was simpler. I was being stubborn. A trader who averages down isn't managing a trade. He's negotiating with his own ego. And in that negotiation, the ego always wins, until the account is empty. When you add to a losing position, you're telling the market you're wrong and I'm right. But the market doesn't care about your opinion. It only cares about price, and price is the final judge, jury, and executioner. Every time you double down on a bad trade, you're borrowing confidence from the future and paying for it with capital today. I once watched a trader lose everything because of this mistake. He started small, confident the market would rebound. When it fell further, he told himself it can't go any lower. So he bought more. It did go lower, and he kept buying, not because the setup made sense, but because admitting defeat felt unbearable. By the time he stopped, there was nothing left to save. The lesson is simple. Never add to weakness. Add only to strength. If a position moves against you, it's the market's way of saying not yet. Respect that message. Close the trade, take the loss, preserve your army. Remember, the market doesn't reward the stubborn. It rewards the discipline. When you're wrong, step aside. When you're right, then you press the advantage. Don't average down. Average up, but only after the market proves you deserve to. Rule number 4, know the line between speculation and gambling. There's a fine line between speculation and gambling. Most traders cross it without even realizing it. A gambler seeks excitement. A speculator seeks opportunity. The gambler wants to feel something. The rush, the thrill, the heartbeat that says, I'm alive. The speculator wants to know something. He wants reason, timing, confirmation. When I walked into the bucket shops as a young man, I saw hundreds of people staring at the tape, their eyes wide with hope, their palms sweating. They weren't studying, they were gambling. They were looking for luck, not logic. I learned early that speculation isn't guessing, it's waiting. It's studying the rhythm of prices, the behavior of crowds, the pulse of human emotion. The gambler risks everything on a hunch. The speculator risks little, but only when the odds are clear. The gambler bets on emotion. The speculator acts on evidence. If you trade for the thrill, the market will humble you. If you trade for the truth, it will eventually reward you. So before you place your next trade, ask yourself, am I trading because I know or because I hope? The answer to that question will tell you exactly which side of the line you stand on. Rule number 5, risk small, think big. Most traders do the opposite of what works. They risk big and think small. But the secret of lasting success in speculation is to risk small and think big. Because great fortunes aren't built by taking massive bets. They're built by surviving long enough to catch massive moves. When I placed trades, I never risked more than a small fraction of my capital. If I was wrong, I could walk away unharmed. If I was right, I had enough strength to press my advantage. That's how wealth compounds. Not through heroism, but through consistency. Every trader has two enemies, the need to be right and the need to get rich quickly. Both will ruin you. When you risk too much, every tick against you feels like an attack. You lose clarity. You start managing emotion instead of risk. The traders who last don't chase every opportunity. They wait for the ones that truly matter. And they place small, controlled bets on those. That's how I built my fortune. Not by trading more, but by trading less and risking less, until the market itself proved I was right. So remember this, risk small but think big, because small risks done wisely open the door to great rewards done patiently. Rule 6, wait for confirmation. Patience is the hardest virtue in trading, and the rarest. Most traders don't lose because they're wrong, they lose because they're early. They rush into the market trying to catch the very beginning of a move, as if being first somehow guarantees being right. But in truth, the market doesn't reward speed, it rewards confirmation. In my time, I called it reading the tape. Today, you might call it waiting for price action to confirm. Either way, the principle hasn't changed. You don't buy because you think it's going up. You buy because the market shows you it's going up. You don't sell because you hope it will fall. You sell because the market tells you it's falling. When you wait for confirmation, you're aligning yourself with the market's truth, not your own opinion. It's the difference between anticipation and reaction. The first is ego. The second is discipline. Yes, you may miss the exact bottom or the exact top, but that doesn't matter. The safest money is made in the middle, after direction is proven and emotion fades. Remember this, the goal isn't to be first, it's to be right after the market confirms it. That's where professional trading begins and gambling ends. Rule number 7, always use a stop. A stop is not a sign of weakness, it's a sign of intelligence. It means you respect the market enough to admit that anything can happen. And it means you respect yourself enough to protect your capital when it does. Every time I entered a trade, I knew exactly where I'd be wrong. I didn't wait for panic to tell me. I decided before the battle began. That's what a stop does. It removes emotion from the equation. It turns chaos into structure. But many traders treat stops like suggestions, not rules. They move them lower, tell themselves, just a little more room. They make excuses instead of decisions. And by the time they finally act, it's no longer a stop, it's a surrender. If your stop is hit, it's not a failure. It's a fee you pay for staying alive. It's a receipt that says, I was disciplined enough to limit my mistake. The traders who survive aren't those who never lose. They're the ones who lose well. Set your stop, honor your stop, never move it once it's placed. Because the moment you start negotiating with your stop, you've already lost the argument. Rule number 8, never let a profit turn into a loss. It takes courage to take a loss, but it takes wisdom to protect a profit. Many traders do the opposite. They cut their winners too soon and let their losers run too long. When a trade finally moves in your favor, that's the market confirming you were right. But that's also the moment when greed begins to whisper. It says, don't take profit yet, it's going higher. And fear joins in. If I close now, what if it keeps running? So you wait, and what happens? The same market that once rewarded you takes it all back. I've seen fortunes vanish not from bad trades, but from good trades left unguarded. A winning position is like an open door. But if you don't close it at the right time, a storm will sweep through and take everything with it. That's why I always said, a profit isn't a profit until it's taken. When you're ahead, protect what's yours. Move your stop. Scale out. Secure the ground you've won. Don't aim to catch the very top of a move. No one ever does. The goal isn't to sell at perfection. It's to sell with protection. So never let a profit turn into a loss. Because every dollar you save in defense is worth more than any dollar you make in greed. Rule number 9, avoid overtrading. Most traders fail not because of bad analysis, but because they trade too often. Overtrading is the silent killer of good traders. It drains your focus, your capital, and your judgment, one unnecessary trade at a time. In my day, we called it tape fever. Men would stare at the ticker all day, waiting for movement, any movement. They weren't trading the market, they were trading boredom. And boredom is more expensive than any losing position. Patience, not action, is the mark of a professional. There are times to strike, and there are times to stand still. When nothing looks clear, when price is uncertain or emotion is high, that's not your signal to trade. That's your signal to wait. I've sat through weeks of silence, doing nothing but watching and thinking. The untrained mind calls that wasted time. The seasoned trader calls it preparation. Because when the real opportunity finally appears, you're ready, calm, confident, capital intact. Remember, the goal isn't to trade often, it's to trade well. In markets, activity is not achievement. Stillness is not failure. Trade when the odds align, and stay silent when they don't. That's how you keep your edge sharp and your capital alive. Rule number 10, respect volatility. Volatility is the market's heartbeat. It's unpredictable, powerful, and dangerous when misunderstood. Many traders treat volatility like an enemy to fight, but it's not your enemy. It's a natural force. And like the ocean, you can't control it. You can only learn to sail with it. When markets become wild, most traders do the worst possible thing. They trade more. They chase the chaos, trying to catch every spike, every drop, forgetting that volatility is a storm, not an invitation. I learned early that you don't stand tall in a hurricane. You lower your sails. You protect your ship. You wait for calmer winds. When volatility rises, reduce your size, widen your stops. Let the noise pass before you step back in. If you can remain patient in the storm, you'll be ready when the air clears. But if you try to fight the waves, you'll drown, not from the sea, but from your own pride. Volatility doesn't ruin traders. Their reactions to it do. It's not about predicting the storm, it's about surviving it. So the next time the market roars, don't rush in with bravado. Step back, breathe, and let the fools destroy each other. That's when opportunity begins to whisper again. Respect volatility, because when you respect the market's power, the market in time will respect you. Rule number 11, keep records, not regrets. A trader without records is a trader without direction. Every decision you make in the market, good or bad, is a lesson waiting to be studied. But most traders don't want lessons, they want excuses. And so they repeat the same mistakes, wondering why the market never changes. I've kept journals since my earliest days, not of predictions, but of emotions. How I felt before a trade, how I reacted when price moved, and what I learned when the dust settled. Patterns emerged, not in price but in my own behavior. That's when I realized the greatest enemy in trading isn't the market, it's memory. You can't trust your memory. It lies to make you feel better. But a written record tells the truth, cold, clear, and merciless. And in that truth lies improvement. When you write down your trades, you're not documenting numbers, you're documenting yourself. Don't regret your losses, record them, study them until they lose their power over you. Regret will only drain your energy. Records will sharpen your mind, and when history repeats, and it always does, your past pages will whisper the answer before emotion can mislead you again. So keep records, not regrets. Because traders who study their past earn the right to profit from their future. Rule number 12. Never risk reputation for reward. Money can be lost and earned again, but reputation, once stained, rarely recovers. I've seen traders who'd risk everything for one more payday. They'd twist the rules, bend the truth, or take advantage of those who trusted them. They always made money fast and lost it faster. The greatest asset a trader owns isn't capital, it's credibility. Your word, your integrity, your discipline. These are what the market respects most. If people can't trust your trades, if you can't trust your own honesty, then no amount of profit will make you whole. Never manipulate, never mislead, never take a shortcut that costs your character. Because when you compromise ethics for income, you've already lost the game. Even if the numbers say you've won, you can rebuild wealth, you can rebuild systems, but you cannot rebuild honor. So guard it, trade clean, win clean, and sleep like a man who fears nothing when markets close. The closing lesson. You've now heard my 12 rules of risk management, each one simple, yet costly to ignore. They're not tricks, or secrets, or shortcuts. They are reminders, timeless truths forged in the fire of experience. If you forget them, the market will remind you, and its lessons are expensive. But if you live by them, you'll outlast the crowd that chases luck instead of learning. Because in the end, trading isn't a test of prediction, it's a test of character. You will face greed, you will face fear, you will face fear, you will face doubt, and temptation, and pride. The market will expose everything within you, the impatience, the ego, the hope, and that's why most fail. They're not beaten by price, they're beaten by themselves. So remember what truly matters: discipline, patience, survival. Your goal isn't to win every trade, it's to stay alive long enough to let time and experience make you wise. I once said the game of speculation is the most uniformly fascinating game in the world. But it's not a game for the stupid, the mentally lazy, or the emotionally unstable. Be none of those. Be disciplined, be deliberate, be patient. Protect your capital, protect your mind. And maybe, just maybe, you'll be among the few who master both. If these lessons spoke to you, subscribe to this channel now. Together we'll keep building what truly matters: clarity, courage, and control in the markets. Because fortune favors not the fearless, but the disciplined. This is Jesse Livermore, and these are the principles that kept me alive when others fell. Guard your capital, guard your mind, trade less, learn more, and let time prove your wisdom. If you want the next lesson, the psychology behind these rules, subscribe now and join me for the next chapter of trading mastery.